Everyone, for folks joining us, we are just going to kind of give it about a minute or so before we get started. But thank you for attending today and look forward to talking with you. Just in terms of a few housekeeping options, or rather housekeeping notes for today, if you do have questions, we have a chat feature. Feel free to drop them in terms of what we can see. And as they pop up, we will try to address them. We will also be leaving some time at the end of today's webinar to talk through any questions that you might have. So feel free to either drop them in the chat or wait until the very end and kind of ask them then. But either way, um, we have a few options. So. Seeing a few more folks join, just for folks that have just joined, we will get started in about a minute. So thanks for joining. All right, I think we can get started. So, by way of quick introduction, my name is Sean Wright, and I am the Chief Insights and Analytics Officer here at Guideline. Been here for about 8 months, doing kind of looking at the market, understanding where trends are going, and trying to use our data to figure out what is coming next from a media and ad spend perspective. Today's presentation, we'll be talking through the 2025 trends, what we think is shaping up to kind of give us a better outlook for 2026. And then really talking about kind of how to plan and kind of think ahead for the 26, 27 upfront, particularly in today's uncertain times with the economy, with kind of shifts in consumer spending, consumer behavior overall. So how is it that we kind of navigate through that? But to kind of kick things off, I think for folks that may not be as aware in terms of what Guideline is, I think it might be helpful to kind of just do a quick couple of introduction slides. So Guideline is kind of a few different companies. We have kind of a host of planning tools, media tools, and Lumina really gives us the option to kind of talk to folks that do agency planning or client brand planning in terms of here's your media plan, how are you going to put it together, and then ultimately bring it out to market. Media costs is a tool of ours where we kind of look at CPMs in market. And then Guideline SMI, which is really going to be spending a lot of our time today, is really a deep look into spend and pricing and going back both in terms of historic as well as into the future. But specifically on our pricing product, it covers about 90% of agency media spend in the US. We have a unique relationship as opposed to some of our competitors in the space where we work directly with agencies, both in terms of holdcos and a lot of the mid-sized to large independents across multiple countries, the US, UK, you can see the countries here, New Zealand, Australia, etc. And collectively, across all of these countries and our agency relationships, we see about $200 billion total in terms of ad spend flowing through our platform. What's unique is that we don't do projections. We are simply kind of repackaging and anonymizing the data that we get from our kind of relationships with our contributors to then look in depth at what's happening in the market. Collectively, we cover over 5 years of history. In some countries, going back as far as 20 years, depending on the country, but five is kind of the standard. And look at 87 individual product subcategories, as well as a host of other kind of media features, ad formats, and the like. And so, what we're going to be doing today is really spending a lot of our time digging into this ad spend specifically as it relates to understanding where the market is today and where the market is going tomorrow. So with that, we'll get started in terms of just reviewing 2025 and kind of hitting on a few key highlights. So the first place I usually like to start is just kind of give a sense check of where we ended up for the year. So if we look collectively, we kind of break it up into a few unique buckets. Digital in this case is everything kind of net CTV. So think search, social, websites, digital content, podcasts, and beyond. Collectively, kind of inline growth for 2025, similar to years past from a average perspective. Growing at about 13% in our data versus a normal kind of 12. So healthy growth, but not anything kind of abnormal. CTV, we saw a bit of slowing in 2025. We think that that's really related to maturation in the market. As kind of the streaming world has evolved, we're reaching a pinnacle of the amount of users consuming content on streaming, the amount of advertise or the amount of publishers at this point out in market with some sort of AVOD option. It has now kind of reached a kind of collective total. So the piece that we're seeing around slowdown, we think is really tied to kind of just market maturation. And we'll get to a few slides where we talk a little more in depth on CTV. Linear seeing continued contractions year over year in terms of just what we're seeing in our data. Not wildly out of line with years past, but certainly a kind of continued slowdown. Really drilling into that, a lot of the dollars really flowing out of cable. Broadcast and specifically sports are doing very well in linear and tend to be areas of growth, which we'll also talk to. And then traditional other is kind of everything that sits out of that. So think radio, print, out of home continues to contract, but maybe a little bit slower. Out of home really being the kind of opposite in that regard from a growth perspective in this traditional other bucket. Did see growth for 25, and we're expecting growth in 26 as well, which we'll kind of talk to. So if we kind of decomp it, the prior chart in terms of just a little more in depth, so kind of going back, starting from the left-hand side, linear, seeing some of the continued contractions, calling out here that the out-of-home piece, if we strip it out of that traditional bucket, did grow. And then kind of moving along, retail media, we see continued strength coming across in terms of ad spend. Despite all of the conversations around Gen AI and shifting behavior there, search continues to grow on our platform, and we expect it still to continue to grow. We'll talk a little bit about kind of the outlook we have for search, and then social and kind of rounding out remaining digital, which in this case are things like podcasts, websites, and beyond, all seeing significant growth in our platform, and no doubt will probably continue to grow for this year into next year as well. So if we kind of highlight and think about the left-hand side first in terms of some trends around what's happening in the traditional market, I think there's three challenges why we're not seeing the shift from traditional budgets back into areas of growth. So if we think about, the CTV market certainly hasn't grown as fast as the linear market declined. So why is it that there isn't this one-for-one parity in terms of what's happening, given that the products are pretty similar? And there's really three things that we see as a challenge, maybe a headwind for traditional publishers trying to kind of hold on to those dollars and those budgets. The first is from a changing priorities perspective. Largely, we've seen this big shift where historically a lot of the traditional budgets are really sitting in kind of brand top of the funnel metrics. But what happens is as those budgets get cut, they're not necessarily just then being cut and reallocated elsewhere, but fundamentally being cut from both top of the funnel and a traditional bucket, and then moving over to digital and being specifically performance targeted. At least in terms of what we can see in our data, if we think about the traditional formats, like a linear and out of home. That's roughly 90-10 in terms of what we have visibility to in our data. But if we look at our digital properties and where the spend is sitting in terms of campaign objectives and marketing objectives, it's actually 40-60, skewing more towards, the performance end of the world. And so there isn't this one-to-one parity in terms of where we're seeing those dollars shift. A second is pricing pressure. So there are, many places where moving a dollar off of a traditional format and trying to then kind of find the same version of it on the digital side is really kind of priced at parity. But there's a lot of other options on the digital side for far cheaper. If I move a dollar from, a broadcast environment, spending, let's call it $32 CPMs, I can move that to YouTube for under $10. I can move it to search for much cheaper. I could even move it to, TikTok for, $3 to $4. And so the tension is as it migrates from one place to another, I also can realize significant cost savings by reallocating those dollars into places where it kind of finds the right audience at the right price point and gives me the return on ad spend. So that's another reason why we're not seeing one-to-one. And the last is a fragmentation of audiences, which I'm sure everyone on the call knows and lives and breathes every day. But it used to be where if I wanted to find 10 million people in a single night, I could run on any number of broadcast shows. But today that option is not there. In order to find those folks, I now need to go to multiple different publishers, different types of ad buying in order to just reach that same volume of people. And so as a result, there's this bigger push towards efficiency because if I have to find that many people and really hunt them down, I want it to be as efficient as possible in terms of an ad buying perspective. So that's a few challenges that we are seeing for the traditional space that we expect to continue into 26 and 27. But I also want to highlight a few areas where we are seeing growth, but also kind of a call out of maybe in 26 we might see something a little bit different. So the first place we'll talk is retail media. If we look at retail media ad spend overall, we are seeing consistent healthy growth in our platform. Double-digit growth essentially all year long. But the interesting thing is that if you look at the monthly active users in retail media, they're kind of plugging along. You can see that the growth and trajectory of how many users are on retail media hasn't grown exponentially. And if we double click that even more, in terms of US adults, roughly 80% of the US population has some sort of retail media subscription, whether it's an Amazon Prime, whether it's through Walmart, whether it's through a loyalty card to Lowe's, right? At this point, we've probably reached a max amount of US adults in terms of folks that are bought into retail media. So the bigger question that kind of begs is, okay, if users are not going to grow, but we want revenue to grow, there's really only a few different levers that retail media networks can do in order to facilitate further growth. We'll get to it, but we think a lot of it's going to come from an expansion of ad inventory. But a lot of places in the retail media networks themselves, there's not really space for that. So they have to collectively start looking off-prem in order to kind of continue that growth going into 26 and 27, which is also a fundamentally different proposition for why you might buy retail media. Not saying that we aren't expecting retail media to continue to grow, but just that the growth might come in different ways or without exceptionally more users on platforms, the growth might kind of change in terms of trajectory going from, anywhere from 25 to 30% year over year. But is it more likely in 26 and 27 to see something akin to, 12, 15%, given some of the limitations here? The second is around search, right? I think there's a lot of conversations of what's happening with search as Gen AI continues, what happened, post ChatGPT introducing ads. And what we're seeing is actually a bit of a divergence in terms of consumer behavior, which also is translating into the ads themselves. From a consumer behavior perspective, is actually in a search world where we're looking at Gen AI search in addition to old school search, we're actually seeing both of those things grow. They are working together in terms of actually collectively all of searches happening more. And what's happening is for a lot of folks, not all, is they're using them for different things, almost as though they are functionally different in terms of the funnel. Gen AI, we are increasingly seeing as more top of the funnel, really about boosting awareness. Often it is being used as a search to say, I want to buy a new backpack. Can you summarize reviews of the best backpacks that can fit a 15-inch laptop and a water bottle? And Gen AI is really great then in kind of going out, summarizing those findings, and then aggregating them in total to say, here's the top 5 backpacks. What's interesting is what we are seeing from a lot of consumers, not all of them, is then using that information to go over to a Google and to a lesser extent to Yahoo, mostly Google, and then saying like, I want to buy this JanSport backpack. I want to buy this Patagonia backpack. I want to buy whatever backpack. They will then go type in that specific backpack and use that to navigate directly to where they want to do a purchase, or maybe not even using Google or Yahoo, but maybe redirecting to Amazon directly or the website of the brand themselves to go and purchase that specific backpack. And so these diverging trends are happening where search is traditional search, if you want to call it traditional, is largely being used to have very targeted types of information finding or a very lower funnel, right? We've already kind of gone past the consideration phase. I'm now already moving into some sort of buying behavior. Google SEM, SEO still very much plays a role in that consumer journey. What we are seeing on the Gen AI side is, despite pushes to try to make it more e-commerce and commerce connected, is largely being also used as top of the funnel for consumer behavior. Doing that research, trying to build awareness and understanding, is largely what we are seeing kind of in the world of search. And what's interesting is that despite all of the narratives we're hearing in the market of like, oh, Gen AI is coming for traditional search, it's going to steal all of the money. At least in terms of what we can see, is that is simply not true, right? We see continued growth in the platform. We see continued money being reallocated to traditional search. Now, what is interesting is now 2.5 months into Gen AI, we are actually seeing ChatGPT ad spend show up in our platform. And it is growing, but it's not growing at the expense of search. And so we think that there's a world in which going forward, both of these things live together as a way to kind of address two different areas of consumer behavior when it comes to funnel objectives and targets in terms of goals. So to kind of recap, right, traditional budgets are shifting as the consumer change their consumption over to digital, but the dollars are not necessarily flowing one to one, right? They're fragmenting. Number two is, retail media networks are experiencing incredibly rapid growth. But if we think about 26 into 27, are there scale challenges there in terms of thinking about opportunity? And if scale happens, right, then the two levers that retail media networks can pull is either increase price on a CPM basis or go out and try to find more ad inventory as either a reseller or a partnership in terms of expanding there. And then lastly is from a competitive AI perspective, search overall continues to grow both in terms of ad dollars flowing to it and consumer behavior. Looking ahead to 2026 is kind of where we'll kind of start. There's a few things that we want to highlight as growth engines. And the reason why we want to highlight them as growth engines is these are the places where we think strategically it makes sense to bet on early from kind of an upfront positioning, a securing revenue earlier, because we think that these are places that are still going to continue to experience growth despite maybe some of the economic headwinds that we'll get to. And we think that kind of the growth drivers here are really places where there will still be demand. And so as a result, probably scarcity of supply and also, potential price considerations as kind of more dollars chase fewer places where there's potential growth. So with that is, linear sports or live sports continues to support linear TV. We don't expect that to go away. For a few different reasons. Number one is, there's still a tremendous amount of demand. If we even think past the World Cup going into next year, it's still one of the few places where you can reach millions of people in a very short window, and still has a very engaged fan base. Is still very much something that does well in terms of linear and CTV, and is also kind of still part of that like traditional must-see TV. These are places where it's no fun to consume the content in delayed viewing. You want to see it live so you can be part of that experience. So there's still a desire and drive to these places, which is why we think it still will continue to be a growth engine both on the TV side and to a lesser extent on the streaming side. Not lesser, but also on the streaming side. So collectively, the other question is, well, as the growth happens here, is it just because the market is shrinking? And there's a couple of dynamics that we're seeing in terms of sports. Number one is it's certainly, a CPM consideration in terms of growth that we're seeing there versus the rest of the linear market contracting. But it is also just there's more ad supply as it relates to sports. And so we are seeing growth there just from a pure demand perspective. But for next year, in the end of this year, we're expecting about 40% of all of Linear's dollars being attributed to live sports only, which is up from 19 back all the way to 2017. The second is from a CTV perspective. The interesting dynamic here is we are seeing a massive shift into programmatic and away from direct sold, which actually, obviously has implications for both buying and trying to transact on it. The more it becomes a programmatic offering, the more it becomes a commodity rather than trying to kind of talk about the values of the premiumness, talk about ways that it's differentiated from the rest of the market. But it's a tension because as dollars move more programmatically, it also opens publishers up to more clients, potentially. It opens up from the more demand channels and potentially different budgets overall. So for the end of this year, we are expecting growth to continue in CTV, but a lot of that growth really coming programmatically. In 2025, if you took direct sold out or if you took programmatic out of the CTV market, essentially CTV would have been flat. Both in terms of like streaming plus whatever hits your TV. So adding in programmatic is really where we expect the growth to happen, and reaching about 50% of overall ad buys in CTV for this year, for 2026. From a retail media perspective, I think we highlighted this and kind of talked a little bit to it, but just want to kind of highlight to say an interesting dynamic that we're seeing is not that Amazon isn't growing because they are a massive grower and we're seeing continued strength there, and we're projecting 22% growth for 2026 on Amazon specifically for their retail media piece, but also largely. The kind of traditional retailers outside of Amazon are pretty much growing at the same rate. Where we are seeing massive expansion is really happening in kind of the adjacent media networks. So think connected from United, Instacart, Uber are all examples of places where there are media networks that are growing that offer similar value and propositions in market to an Amazon or a Kroger or a Target, but are also offering kind of differentiated ways to engage with consumers and target in terms of advertising. And that's actually where we're seeing a lot of dollars flow. The other interesting thing is that we are expecting most of the growth to be shifting away from on-prem into off-prem. Highlighting in the last couple of slides, really that challenge for us or the market is retail media, as we know it, is kind of reaching this maturity in terms of users, in terms of, just collective amount of ads that can be served up in these platforms. So a lot of the transition is going to be really focused in on how do you grow the ad supply in a limited environment from a user perspective. And so that's where we're really expecting a lot of the offsite, ad dollars or ad supply to be kind of bolstering the growth to retail media overall. And then the last one we would highlight from a growth engine perspective is podcasts. I think there's a lot of conversation, right? Have podcasts reached their peak? Is there still interest in podcast? And collectively, we would say yes, right? It is a huge growth engine, despite being a relatively small portion of digital audio overall. We are expecting kind of almost half of the growth to be coming from podcasts alone, and about a third of overall digital audio revenue in 26 coming from podcasts. So we expect it to be a continued growth engine and also a place where both there are consumer demand for it, as well as an interest in advertisers around that space in terms of targeting. Because in many ways, it's functionally an endemic media. You don't need a lot of targeting if you are looking at very niche podcasts. You kind of know who's listening into it, and it works well in terms of targeting and planning. So those are some of the things that we would highlight for 2026, 2027. And again, as a reminder, if there are questions, feel free to drop them in the chat. But want to kind of highlight real quick the planning for 26 and 27, because I think the big question out there is what's happening, right? There's a lot of uncertainty when it comes to the economy. How might that impact advertising? How do I hedge against those risks when I think about plans and budgets? And so I wanted to talk through a little bit of that. So on the first place is one, our forecast for 26 is, roughly we think the market will come in around 4% up year over year. And part of that is a bit of the diverging trends in terms of the traditional formats we still expect to continue to contract, whereas we expect a lot of growth to be happening on the digital side. We do want to highlight that this is really just for our guideline pool data only. So that kind of 200 billion that you heard about earlier, this is not the collective market. So again, where we're thinking about growth is really in kind of the holdcos, the large to mid-size agencies. But there's also a few reasons why we are kind of more bearish than maybe some other forecasters out there. One, the economic uncertainty continues to weigh on consumer spending, and we know that probably the single largest driver of ad spend in the market is how consumers are spending. If consumers aren't spending, advertisers are really reluctant to go out there and try to kind of pitch them on buying additional stuff or different stuff. And so as a result, we are starting to potentially see some of that lag. And we also started noticing it as late or as early as Q4, which is partly why we have forecasted that 4%. But we do want to talk about some of the ways in which, kind of planning for the upfront, the buying power is really shifting into, or I should say, the power is really shifting away from a seller's market in 26 back to a buyer's market in 27. And there's a few reasons for it, which we'll get to in a couple of slides. But number one, a huge boost for this year has been kind of a few concurrent events that are happening both globally and in the United States that really makes it kind of a must-have moment. Obviously, the Olympics earlier this year, the World Cup only comes around every 4 years, and it's a massive event that drives advertising globally. And then also in the US specifically, to a lesser extent, US midterm elections. So it's this confluence of many different one-off events really made this kind of, from a buying power perspective, shift over to folks who sell ads, publishers, because there's scarcity of inventory that only comes around once every 4 years. That's also guaranteed to drive a lot of impressions and a lot of excitement in market. So whether it is actually advertising in those moments or providing advertising on the peripherals that tries to be kind of a part of the conversation, but not necessarily in the moment at the costs that some of these kind of events go for, all helped drive a lot of the demand in market for 26. But obviously for next year, those don't comp, right? You have the Super Bowl that's happening, but that happens every year. You have March Madness in the US that happens, every year. These are the types of events that certainly drive, spikes throughout the year, but they are comping same numbers as last year. So the kind of buying power is really shifting back over to sell to buyers. The other piece being is that in times of uncertainty, right, budgets are a bit more in flux, and so in order to secure that scarcity, there might be more of an interest from sellers, of publishers, in trying to negotiate deals earlier in order to kind of address some of that uncertainty that might be coming in the second half of this year into Q1 of 27. So that being said, in terms of what we are projecting, if we look at the total market of kind of this upfront reserved ad buy dynamic versus this scatter always on, we are seeing shifting behavior, obviously, over time. Part of that can be explained from a kind of growth in digital and programmatic, which certainly is a component of this. But even if you drilled into and just looked at kind of the linear plus CTV environment, that area has also experienced kind of this holding pattern where there hasn't been expansion in terms of upfront dollars. It's been pretty consistent of, let's call it, around 65 to 70% of dollars flowing in through kind of the TV/CTV market has been held in the upfronts versus the rest is up and scatter. That has kind of held steady. So as the market grows elsewhere, but that is one place where it's held, overall kind of upfront and reserved ad buys are coming down in terms of overall kind of growth in the market. And part of that is also there's a bit of uncertainty kind of post-pandemic in 2020, where budgets have kind of moved from these annual or even multiple year allocations into even almost quarterly views, where here's your budget for the next quarter, how do we kind of plan effectively for it? And so it's harder to buy into the future if you only have line of sight into, let's call it 3 to 6 months on budgets. So as a result, we've seen kind of this dynamic around trying to get ahead of things really diminish. Now, one of the benefits, obviously, on both ends of the fence is that you secure things early, right? There's usually a price benefit to negotiating early, but then there's also a peace of mind, especially in terms of uncertainty, that if you know that there's going to be a certain amount of budget allocated in this certain amount of time, you can kind of plan and build around that. And so there are some benefits to trying to kind of get in early rather than doing this always on demand kind of channel. And so there is a tension there, right? Whereas the always on demand gives you the flexibility to address and kind of move budgets up and down. But the call out here is like consumers will still continue to look for products. They will still continue to buy regardless of uncertainty. And so there is that tension there. The other piece that we wanted to highlight is we did some analysis on our pricing specifically, and we looked at the rate of change when the market moves from a buyer's market. So these times of kind of going back over the last 10 years, where there's been kind of these key tentpole moments going into the year. So think a buyer's market would have been 2026, but also in times of relative stability around the economy. So think more like 2019, where there was a bit more understanding of like, okay, like things aren't so bad, we're doing okay. Those are those are seller markets. I kept saying buyers, seller markets. On the converse, what's interesting is when you analyze a buyer's market, so there's no tent poles, there's higher degrees of economic uncertainty. What we've noticed is the rate of change on pricing in market year over year is pretty different. So in a seller's market, between the tent poles, all of those things, even removing the actual tent poles themselves so that we're not inflating costs, the average rate of change, because there's scarcity of inventory elsewhere, goes up about, 3.3%. But in a buyer's market where there isn't kind of the tent poles to hold up the rest of the market from an inventory perspective, the rate of change is much lower at 2.1%, on average since, over the last 10 years. So what that really means in terms of thinking about it is, we think about it as that pricing power really moves back to the agencies, the brands themselves, in order to kind of negotiate more favorable rates. Given that there isn't as much to hold back, there isn't as much scarcity of inventory collectively in the market. Whereas, there's a cyclical nature of this, and eventually it gets back to being a seller's market where there's a lot of scarcity because there's tent poles that take up a lot of space in terms of advertising. And so therefore all, kind of pricing goes up. So the good news is even with on times of uncertainty is that the rate of change for pricing tends to go up at a much slower rate across the whole marketplace. Thinking about category dynamics for a second, just looking at kind of this macro outlook, we also do a variety of forecasting here at Guideline in terms of looking at categories, media types, different countries. And one of the things that we've analyzed is really just the dynamics of what we think is going to happen in 26, leading into 27 around categories. So going all the way to the left, we have kind of the automotive category, which ranges from everything from, parts and services all the way through to the car manufacturers. We expect that to kind of contract the most out of all of the categories we've analyzed, all the way through to the right-hand side of toys and games. A few key callouts that we'll have is one, the automotive sector. We still see structural headwinds going against it, both in terms of ongoing costs related to tariffs, right? The tariff schedule is still in place. There is a couple of different ways that the tariffs are impacting both from kind of the raw ingredients of steel, but also kind of, cross-country trade, moving cars around, and then the end product as well. So there's multiple points at which tariffs are impacting costs. This is in turn driving up your, average price for our car. So consumer demand is a lot less. Basically since the end of last year, we've seen auto sales contract every single month. And as a result, we've also seen ad spend be clawed back. The number of car launches in the US for this year going into next year is basically right in line with like a 5-year average. So it's not really going to be something that moves the needle from an ad spend perspective. So the automotive category, we're seeing a lot of structural headwinds. Uh, Towards the middle, another call out here is pharma. We're kind of, right on that fence of almost flat. And the reason is that despite all of the ad influx around GLP and GLP-1s, between the pill, the shots, that is still expected to kind of help bolster growth. But part of what's dragging on the category is the patent cliff. So there's about 20 major drugs that are coming off patent this year, and we've already started to see kind of collectively the market soften as, likely the demand for those drugs is removed. We are seeing kind of ad spend being reallocated or shifted out of there. And so as a result, despite some areas experiencing tremendous growth in pharma, we're seeing some areas also contract, as well as the dynamics with the FDA on titled letters. It's kind of creating this flat line. And then on the right-hand side, toys and games, kind of coming out of the tariff situation, is expecting to growth. And then also part of our forecast is GTA, the next kind of GTA is coming out, Grand Theft Auto. That alone, given that there's roughly $1 billion cost to kind of bringing that to market from, press and trades that we've seen, we're expecting a lot of marketing dollars to hit up against that. And that alone, single-handedly really driving the overall category, given that the category is relatively small. Travel, we'll talk to on the next page, as well as restaurants and apparel. So we just wanted to highlight them to then talk about what's happening with the economy. So we did a whole bunch of analytics in terms of just trying to understand the dynamics of what's happening as it relates to the ongoing conflict with Iran, the Strait of Hormuz. So we wanted to kind of dig in deep and look at historical impact of things like the price of oil, unemployment. And the reason is there's two things that we are looking at that we hope are helpful. The first is what signal should we be watching for? So on the right-hand side, these are all call outs that say, look, if if each of these measures, the oil, unemployment, liquid natural gas, start to reach these price points or percents, that's where we start to see material shifts in ad budgets. So that's one signal that we're watching in market to understand and how to get ahead of it, both in terms of securing dollars earlier, and then also planning for risk. So when we think about risk, there's a few categories that are particularly sensitive to changes in oil prices, for example. So if we look at the top line, for travel, we've noticed that when oil gets to be about $100 or more a barrel, airlines and cruises will typically start to cut ad spend 2.1 months after the travel category or after oil hits $100 a barrel. So it's not immediate, but we do see those impacts. Secondly, restaurant and personal care is really from like a consumer behavior perspective. Folks are looking to maybe tighten budgets amid kind of paying a lot more at the gas tank. And so those are two categories that start to feel the pain and also then start to cut ad spend as a way to kind of recoup some expenses. And then automakers also kind of feeling it, right? As particularly gas and combustion engine cars start to be less in demand, particularly the larger models out there. There's also then that corresponding kind of lessening of consumer demand, which in turn means that ad spend gets cut. So the thing that we would highlight without going through every single line is one, for categories in this bucket, we've done analyses to say that on average, we would start to see ad spend cut around, 2.1 to 3 months as a lag. So the question is how are we shoring up budgets to make sure that we aren't going to lose those dollars and trying to kind of get ahead of it, both in terms of allocation and placement? But then also kind of diversifying. So if there's a lot of business tied to restaurants, where is there kind of new business in terms of growth? Where is there opportunities to pitch additionally in market where there are some categories that either might be growing or maybe not as affected economically? So that would give you kind of the takeaway that we would frame in terms of the page. And the only other thing that we would say is, oil prices, even if they were catastrophic, $150 a barrel, which is incredibly high. On average, we would estimate that that would take about 0.5% of growth off the ad growth for the year. So if advertising was supposed to grow at 5.5%, even with catastrophic oil prices, we would still be looking at a 5% growth. There's a very big difference, though, when we start talking unemployment, where fundamentally, because unemployment is tied to so many other things about how consumers act in the market, what they buy, where they buy, once that starts getting to 5%, 5.5%, we start to see pretty rapid changes in ad budgets, both in terms of the near term, and then also kind of a lot more uncertainty in terms of planning for the future, where brands aren't as engaged in terms of trying to plan for 6 months, 8 months, 12 months out if unemployment starts to kind of go up. So while we would kind of watch all of these signals, and we do on a weekly basis, unemployment is really where we're focusing our time and attention. So those are some kind of key watchouts as we think about the market in terms of growth. Now, the other thing is, the thing that we would highlight around cutting budgets, and this isn't just kind of me saying this because I've been in the ad space for a while. This research that literally goes back to the Great Depression, where basically it's this consistent theme. We did our own analysis where we looked at guidelines data and revenue for key sectors, and we kind of came to basically the exact same conclusion is that in turbulent times, for every 33 cents cut from ad spend, typically those companies will see about $1 decline of revenue. And the way we did the analysis, because we can't see, brands in terms of our data, is we looked at all of these different subcategories and we got kind of revenue for the top, anywhere from 10 to 50 brands in those spaces. And we kind of looked and said, okay, roughly speaking, here's if ad spend is this, and revenue for these in terms of publicly traded companies is this. This is on average the decline that we're seeing, but this is pretty consistent in terms of other research out there, where for every kind of 33 cents cut to ad spend, revenue is actually what takes the hit. So even though it might be a short-term cost savings, it's a much longer-term impact to the business in terms of what we're seeing. There's also a lot of great research that shows that it's not just immediate, but it's actually many years into the future. And kind of the best case scenario that you could do in turbulent times is really kind of maintaining ad spend or even potentially growing. And there's really two reasons for that is one, it's about standing out. it's kind of this whole like prisoner's dilemma. There's going to be brands that pull back from the market. And so if you are left standing, you are likely the only brand that might be in that space. And so it's really a way to stand out against kind of less of a competitive, cluster around advertising. The second is people still are buying things, even on uncertain times, even when times are tough. It's not that people aren't going out and buying, but they're making different decisions, and it's making different kind of buying decisions about what to buy and when to buy it. So it's actually a great time to kind of introduce loyalty, try to build awareness, and kind of get folks that maybe wouldn't have bought your product before. Now is a way to kind of get in. So there's a few benefits that we would see to even maintaining ad spend in turbulent times. So to kind of recap, number one is we would say if we're thinking about planning for next year is defending ad budgets, right? Especially in uncertain times, pressure often comes. Finance wants to say, okay, like how do we reduce costs? Our pitch would be keeping ad budgets even flat actually benefits much more in both the short and long term, and that a cost savings in the short term is actually much harmful to the company longer term in terms of revenue, loyalty, brand awareness, and beyond. The second is from a hedge risk perspective is as economic conditions kind of weigh against specific categories, is there a way to diversify and also secure upfront commitments in those spaces in order to kind of hedge against risk in terms of what we're seeing? And then also kind of looking to growth areas. So if we go back to kind of a couple of slides, live sports, we still expect to continue to grow. So is there a way to kind of get in early and secure that, given that we would still expect that to continue to be vibrant, also driving a lot of consumer interest and behavior, viewership, etc., as well as a few other places. So that is kind of the recap in total. What I would just kind of say before we'll leave it, kind of for the last 2 minutes in terms of any questions, is one, from a next step perspective, if anyone is attending possible, we will have a bunch of our folks out there. So if interested in kind of meeting and connecting, there's an email here, as well as many of our folks will be on the ground, ready to meet and have a conversation with anybody that's going in terms of Miami. And then the second is, if interested in this, if this was interesting to you, we also offered kind of different ways to customize this specific to your business, right? This is trying to be a one size fits all for many participants on the call. So we always try to make our data more relevant and interesting to all of you. So if interested, you could scan the QR code. We'll also be sending this around later today, or tomorrow in terms of the slides, so that way you have them. But with that, I will just kind of recap to say thank you for attending. We hope that you thought it was both helpful and interesting. And certainly, if you do have any questions, feel free to drop them in the chat. Or if you want to kind of review the deck, our contact information is in there should you want to reach out after and kind of just follow up with additional thoughts, considerations. We are certainly available to do all of that. But I will give it kind of maybe 30 seconds. And if there are no questions, then I hope everyone has a great day.
Hi, Sean. So we do have one question that
Great.
says, how quickly can you turn around custom insights reports? We often have tight windows to collect data and make decisions. So lead time matters a lot for us.
It's a great question. So I would say it's really based on the complexity of the ask, but the quickest we've turned something around has been within kind of a 3-day window. Obviously, we would love a little more lead time in terms of working with you and partnering with you all. But we do offer kind of a couple of different options, but we understand, particularly when it comes to things like RFPs, new business, those are pretty tight windows. You get a document, you're told, cool, I need a response from you in 24 hours. So we get it, we've lived it. Many of us have come from, that side of the industry. So where we can be helpful, we absolutely will be.
Great. And we actually have another additional question that says, quick
Okay.
question. How are advertisers balancing upfront commitments with the need for flexibility in these volatile markets?
Yeah, so we obviously don't have a line of sight into individual advertiser budgets. From what we are hearing in terms of the market is kind of hedging and buying the few key things that we are seeing demand for in the market. Think live sports. That tends to be an area where we really haven't seen any waning interest. Folks are still saying, yeah, we want to upfront commit and kind of buy that in. But we are seeing maybe some hesitancy to buy elsewhere and say, we'll come back to you in the scatter market, or we'll shift programmatically and buy it when we need it in terms of on demand. So we are seeing some of the dynamics at play. Kind of going back to the chart, I wouldn't be surprised. I think we had at around 24% between kind of collectively the market of an upfront slash advanced buy commitment versus kind of a always on in the moment. I wouldn't be surprised if 2027 looked closer to like 23, 22%.
That sounds great. And I know we're getting close to time, Sean. So I'm going to share one last question that we received
Great.
that says, do agencies or brands use your data and insights to help inform strategic media planning? And if so, can you share a specific example?
Sure. I would say there's a lot of different ways our data can be used for specific strategy questions. The first would really be about kind of the conversation here, right? The upfront allocation, figuring out where demand is in market, because that would give us a sense of scarcity and what we would need to buy in advance, right? That would be one example where we've seen that kind of at play and helpful. Another is really looking at pricing data to understand where there's pricing dynamics, where there's potential return on ad spend versus some places where it might be a challenge, given some of our CPM data, is also another place that we've seen it be very helpful from more of a strategy perspective. The other thing I would just highlight is like, partly is we don't know what we don't know. So there's a lot of different use cases that we have found in terms of strategy and application that everyone kind of applies in different ways. But I would kind of also highlight some of the category information has always been something that's interesting to me and where I tend to gravitate, both in terms of just interest in the market and looking at the data. But um, I don't know how many people actually just look at the data for fun. So I'll put myself into a very specific camp of like, I'm jazzed by some of the stuff, but it might not be for everybody. Great. Well, it sounds like that's all of the questions for today. Appreciate your time. Thank you for all of the folks that stayed a little over in terms of time here. But expect to hear from us in the next day or so. Thank you so much for coming, and hopefully you'll join us at our next one when we host in hopefully another couple months. Thanks. Have a good one.